Hey everyone, me Kevin here. In this video, I'm going to talk about how I have shifted my portfolio, what I'm doing differently now than what I have been doing, and well, we're gonna start right now. As soon as I mention that you can still get 40% off the amazing programs on building your wealth, linked down below. Anytime I buy or sell in stocks and psychology of money, anything from crypto options, trades, YOLOs to not YOLOs and fundamental investments, you get an alert in the link down below. All right, folks, let's get right into this. So first, I wanna show this. So I always like to make tweaks to my trading strategy and my investing strategy. And in the last 3 months, it's worked really well. This is my Webull right here. Right now, this Webull 3-month P&L is sitting at 885, and this is about a $4.5 million account. So if I go to P&L percentage here, it's about 24.5% relative to, what do we got here? INX, I don't know what, there, S&P 500. Oh, I guess that's what it shows like on Webull. But anyway, and you can kind of see it like refresh here so you know it's like real, not Photoshop. But anyway, $884,000 on about a $4 million portfolio. Pretty freaking awesome, and I love that. And there are a few things that I've really been changing in my portfolio to make sure that I move with the market rather than try to fight the market. And so I want to start by talking about ARK. Okay, I absolutely love Cathie Wood. I love ARK Invest, and I love the strategy of going long on innovation. I think the best thing that you could do if you wanted to just set and forget your money is go long on innovation, set it and forget it, and don't come back. But that's not what we do in the marketplaces. In fact, when we look at Cathie Wood's flows for her funds, we see that Cathie Wood had the biggest amount of investments going into her fund when it was the most expensive, around January and February of this year. And in the last 3 months, we have seen Cathie lose sometimes hundreds of millions of dollars a day in investments into her fund. In other words, negative investments into her fund are considered outflows, and this means that Cathie Wood has to sell stocks that she holds. People are wondering like, oh my gosh, Cathie's selling Tesla. Well, one of the reasons she has to sell Tesla is because people have been withdrawing money more than they have been depositing money in the last few months. And this is not at all a slam against Cathie. In fact, my belief is you should be buying innovation and growth style stocks when the prices of those stocks are lower, not when they're higher. That makes intuitive sense now when you look back, but in January and in February, what people see is the arrow going up and it's like, oh, I gotta buy, FOMO, 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 FOMO. Now, FOMO sometimes works. There are times when FOMO works when you're getting in on a momentum swing like this, right? Like you get in on a YOLO call option on something that's doing this kind of ride. Even if you get in here and you ride it to here, you're still doing good, right? But you got to play that timing of it. That's different from long run investing. And that's a very important difference for us to remember. When it comes to Cathie's sort of buy it and wait strategy, it's important to remember when you're buying while Cathie's having these negative outflows, in my opinion, you're actually making a pretty decent investment. You're buying companies that do have innovative growth coming in the future. My favorite companies right now, we know this, Tesla, Enphase, Apple, Amazon, Google, obviously, these are some of the big ones. Love the fintech space, Square, Lemonade, whatever, right? These are some of my favorite companies, even Matterport, love these companies. But we're at this really weird place in the market where I've made a transition in the way that I'm exposing myself to these stocks. And I believe this is very important. First, the very first thing I keep in mind is I establish stocks that I know I never want to sell. Stocks that I really ideally keep long-term, and I don't even think about trading them. And that makes up about 80% of my portfolio. Again, the Etsy's, the Enphase, the Tesla, the innovative new 2021 growth companies that are going to be growing 25 to 50% per year for the next 5 years. Those are the kinds of companies that I want, and I buy and I hold these companies. But in addition to that, I have previously, in like the first half of this year, been really big on buying call options, leaps. Leaps were awesome in 2020. You can buy leaps blindfolded. Leaps are just long dated call options. Like that would be like me buying 2024 call options today. something that's quite a ways out, or even 2023 options today, something that's 18 to 30 months out. Those are long options. You pay a big premium for those. I'm staying and have been staying away from those since about May. I've been staying away, and instead I've been closing these as much as possible and taking profits on those stocks on those options as much as possible. But I've also been doing something else. So number one, I focus on my longs, my innovation plays that I can continue to sort of buy the dip on, if you will. Number two, I've been focusing on closing out those long leap contracts. Get those out of my life, and the two reasons for that is every day you hold it costs you money. That's called theta decay. And every day that you also hold it in a market where the market just in general is becoming less volatile, sort of in 2020, if the market was doing this, kind of like your heart while you're running a mile really fast, right? Now it's kind of more doing this. It's kind of just like fast strolling. And then if it goes down to like a walk, right? The smaller that line is, the more your call options get punished that you own. When you own options, you want this. Not in price, just in volatility, because you're building into a contract the potential, these big potential swings, right? So less hurts you when you own these options. Okay. So number one, those long positions. That's the basis of the portfolio. That's money in the long term. Number two, getting rid of those leaps. Number three, selling contracts. And then I have a special number four too. Selling contracts, selling puts to get a lower cost basis into deals. And then when things run and you see an insane kind of like momentum swing up in a stock, sell calls. That these have been so good to me. Selling puts, selling calls have been amazing to me. Over here on my Webull, the Enphase, Tesla, Etsy, these have been doing well because of shares that I held. I held shares, and in some cases I even sold calls against them. And Hippo was an example of a different kind of option, and this is more a short-term kind of call option play where I'll go out 30 to 45 days and do a short-term call option on something like this. Now, you have to be really careful with call options under 45 days because the theta decay is insane. So, in my opinion, either you make it or you break it and you get out. And I've lost money doing that, and I've made lots of money. Fortunately, I've made a lot more money than I've lost, but that is like playing roulette where you have the odds slightly in your favor. I kind of feel like short-term call options are like 70% roulette wheel where you're going to lose 30% of the time, sometimes even for some people 40, 45% of the time. My goal is to keep that at like 70% win rate and 30% loss. But I know there are going to be losses on shorter term call options, so you just have to be careful with those because it's much more volatile and things can flip on you very, very quickly. So what I want to show you now is sort of my cash position and the cash kind of portfolio, and I'm going to recap what my strategy here has been and go through it maybe in a little bit more detail. So take a look at this. This is my portfolio right now. I've got $4.5 million in Webull. In addition to that, $307,000 are cash. M1 Finance, 1.2 million of that 37 is cash. 37,000. Sorry, not of that. It's in addition to that. Robinhood, 1.1 million in stocks, options, and crypto. In addition to that, $970,000 in cash. I just posted a ton of closing alerts as well on Robinhood. I closed like 10 different contracts this morning on Robinhood, so that's why I have a ton of cash right now in Robinhood. JP Morgan, 12.7 in stocks and options, 540K cash. Here's another JPM, 159 stocks, 52 cash. Bank accounts, 14. Public, 79 just in stocks. BlockFi, this is all Bitcoin, 218. Private equity, these are like 3 different companies that I've invested in, 1.7 million. Coinbase, 395. This is for Cardano and Ethereum mostly, which those are way up because I only put in like 100K. So that has been very, very, very much a blessing. 50 here in TD Ameritrade. In cash, that's for like OTC stocks. If I ever buy anything over the counter, I have that ready to go. And then, so this doesn't include retirement accounts, so it's about 22 mil not in retirement accounts, and about 3.38 of that is cash. So that means cash to portfolio is sitting around 15.29%. It was 0% margin, no money on debt against my stocks, And then, of course, there's the real estate portfolio on top of that. Yeah, so how is it possible to pull this off in a 3-month period of time? Well, my opinion, it was really a matter of changing, adjusting my strategy. I want to say. I don't want to say like a big change in my strategy. It's an adjustment. You have to kind of move with the market. You got to know, okay, volatility's falling. Time to dump those leaps. Time to sell contracts instead, because as volatility falls, your sold contracts go up in value. So this really, really helps. When there is momentum, identify this has become a momentum stock. That means when it starts falling and the momentum's over, the momentum's over. Even though it might have tiny little blurps back to life, when the momentum's over, it tends to be over. So something to watch for. You're always going to have crazy fluctuations in the market, though, so recognize that as well. But consider the 4 main things here. Long on big portions, big things you really, really believe in. Minimizing the amount of leaps you have. Selling puts and selling calls to lower your cost basis. And then 4th, when you do the YOLOs, recognize momentum quickly and fast, in, out, but keep that to a small part of your portfolio. In my opinion, I call that like the entertainment portion of the portfolio to make the other stuff fun. So you want to be careful with that, though. You don't want that to be your whole portfolio. You should be buying real estate instead. And so this is where you can kind of see the manifestation of that sort of real estate cash crypto in my portfolio. A lot of stock, no debt, but you're seeing my cash balance grow substantially. And I'm buying a real estate deal. I'm closing on a real estate deal next week. You've seen my crypto balance grow. And so this is really because I've transitioned in this market very slowly. I think just there are more modifications than transitions. It's not like I took 80% of my portfolio that was long tech and I just dumped all of that and went into like a REIT, right? Or went into like, I don't know, industrials or defense stocks or whatever. It's not like I massively U-turned. Really what I just did is I decided, okay, I took my portfolio that's really, really long, innovation and growth, moved some of it in May into long call options. A lot of them did very well. Some of them did not do very well. And then realized, okay, calls, we're going to be in a problem if we continue through this volatility crush, which was the last thing we were really thinking would happen between February and May. Because come on, like between February and May, that was such a bloody market. It seemed like volatility would be going up, not down, right? But volatility got crushed between then and now. And so that's why it shifted to selling options. And this has been very, very beneficial. Just to give you an example as to how this could work. So that way, like if you're not familiar with how to do this, this would, I think, give you a head start. Okay, so here is an example of where Robinhood had this insane momentum and this insane run. I did not peak sell these calls, but I did sell 100 call options against Robinhood. One set of 50 and then another set of 50. One on this day, one on this day. So what I did with this contract, just to show you an example of the strategy, is when Robinhood was at those highs, I thought this is really high. This is crazy momentum. Robinhood is not worth $70 a share. Let me just go ahead and sell a call option to somebody else. That means I'm giving somebody else the right to buy my Robinhood shares for $75 on or before December 17th. Usually they don't exercise you before that date, but they could. But anyway, I gave somebody this right, and I got a credit for about $57,000 in exchange for making that agreement. Now, we're not yet at December 17th, but this morning I realized that this contract, its market value, has already realized the potential of 93% of that $57,000, which means I can now go to the marketplace, buy that call option back that I sold, which closes it out basically, because I sold 50 contracts. Now I buy back 50, and I'm just paying $3,750 to do that, which you could see right there under my head. I would pay $3,750 to do that, and then I would keep the $53,000. And I keep my shares, right? So now I could have sold the Robinhood shares, but this just gives you an example of how a covered call can really help you hedge yourself when there's crazy momentum, especially in a market where volatility is going down, which is in your favor. Remember, when you sell option contracts, you gain theta decay. The seller gets the theta decay. And when volatility goes down, the seller gets that volatility benefit in pricing. So this is how I've modified my strategy in these 4 ways. And some people are like, oh, Kevin, like one day you're talking about RCC and the next day you're buying stocks. That's okay. That's the point. The whole point that I'm putting money into like real estate, cash, crypto is so that when opportunities come up for me to buy in the stock market, I can buy them. But right now I look at the stock market on a daily basis. I'm like, what is there to buy? Like nothing's like a screaming deal right now. I mean, I think Hippo is way undervalued, under $5 right now at $4.95. I think it's way undervalued. That's why I bought it the first time. I bought it for like $4.80 the first time around. I thought, oh my gosh, under $5.25, this is a screaming deal. But whatever, you know, maybe it had some momentum and then that evaporated. Fine, that happens. Still think it's a good deal. You can't like arm wrestle the market. But anyway, yeah, these are my thoughts. So I really appreciate you watching this video. Hopefully this update was helpful and insightful for you. If you like this kind of content, check out the program's link down below on building your wealth. Go to metkevin.com/join. Use the coupon code down below. And folks, see you in the next video. Thanks for watching. Bye.